Hi there, this is Christian Dye from Latitude West Financial, and today is our year-end 2022 stock and real estate market report. I've got Ryan Runte from Stonehouse Realty and Dara Fahy from Citywise Mortgages joining me in order to update us as to what is going on in this very, very interesting market that we're in right now. Before we dive right in, just a quick reminder that today's information is not to encourage the buying or not buying of real estate or the buying or not buying of any stocks. This is for educational purposes only. Reach out to your qualified advisor if you are going to make any changes to either your real estate or your portfolio. So let's dive right in. Right now, the data that we got from last month helps us to figure out the trends of what's going on in the housing and real estate market. So right now, as you can see, the Metro Vancouver, the average benchmark price is about 1.131 million, which covers both condos, apartments, townhouses, detached houses. Now, this over here is a 10.2% decrease over the last 6 months, and about a 1.5% decrease from this time from back in last year at the same time. So what we notice is that you kind of heard that there is a price drop. So the data now shows it. This shows the average days on market and the average price. So we went up quite quickly. So now we're sort of dipping back down. Now, what type of market are we in? Just a reminder, analysts predict sales to active listings. When they're below 12%, they say it is more of a seller's market. And sorry, it is more of a, but when sales to active listings is below 12, it is more of a buyer's market. And when it's above 20, it's more of a seller's market. If you take a look at January, all the way at the beginning of the year, it was very far above the 20% mark. And in March, we seem to have peaked around for townhouses and condos. And then it slowly started to come down, In the summer, it slowed right down. And now where we are as of data that we got in last month for November, we're at around 17.6, which kind of puts us in balanced territory, but heading towards definitely a buyer's market territory. So we feel that the market, according to the numbers, is going to continue to slow down, continue to decline. But we bring in Ryan Runte. He is our realtor on the front lines, and he could kind of tell us what exactly is going on from his perspective. So Ryan, I'm going to shift over to you to let us know what is happening right now.
Good morning. Yeah, so I think those stats are maybe a little bit off from the board. I know they're maybe like a month behind. I would say we're probably in a buyer's market. I mean, for example, right now we have 5 listings, and some of them aren't even getting calls at the moment. Part of that might be also where, December and people are busy with family stuff, but there's definitely a slowdown. So I would say we're probably in a buyer's market right now. A couple of things is to kind of mention. So the updates with the strata bylaws, which is interesting. So now any strata, you can rent it out unless it's a 55 age plus restriction building. So that's actually, I think, a positive thing. That's going to open up more rental opportunities. And there's some older buildings, for example, in Vancouver that you can get under 700,000, 2 bedrooms that would have quite high rent. So for investors, there's some good opportunities now with some of these ones. And then for sellers, if you got a job somewhere else or forced to move or couldn't pay your mortgage payments, now you can rent out your condo. So that's actually good news, I think.
What would you say is the the climate out there for any offers you are seeing? Are people looking for a pretty heavy discount now, or are they still kind of close to asking?
It seems like a relatively high discount, like from our buyers, a lot of them wanting to throw out lowball offers just to kind of see where it lands. But I would say you're probably looking at about 3 to 5% off of the asking price at this point. But a lot of buyers are looking for that deal or that really motivated seller. And it just depends. Some sellers are still that mindset. Their neighbor sold for a higher price back in the spring, so it's tough to get some sellers down in price. We've wrote some offers I feel that were reasonable, and the sellers just weren't willing to take them. But in general, most buyers I think are looking for that deal right now. Oh, I think your volume went off.
Can you hear me now?
Oh yeah, there you go.
What do you think is the future outlook then?
Yeah, like I don't think the bubble's going to burst type of thing. I know there's a lot of panic out there. I do feel with the rates obviously increasing still, we're going to have a slower year in 2023, and we may decline another 10%, but I think again, we went up so much the last couple of years that we're just kind of coming down from that peak. So there very well may be a further decline, but it's a positive for buyers because you're not competing with 10 people like we were in the spring. You have a chance to do your due diligence. You have a chance to probably get a pretty reasonable price on something. So overall, it's a good time for buyers. But I do feel, we're probably headed to a further decline for 2023 until the rates start to come down.
Sure. No, that's fantastic. So I think a lot of people are kind of almost saying the same thing and seeing where the tides are shifting. Okay, let's take a look here. We're going to shift gears over here to Dara Fahy from Citywide Mortgages and what is happening in the mortgage market right now. Dara, you with us?
Yes, good morning.
All right, so tell us, what are you seeing?
Yeah, so lots happening in the mortgage world. The latest is that the Bank of Canada increased the prime rate on Wednesday by another 0.5%. So this is now an all-time, well, not an all-time high, but this is a high, the highest it's been since probably 2008. So close to 15 years, which is painful for a lot of people right now. We've seen the borrowing and the prime rate basically triple since March 2022. So the interesting thing this time around, we've been following every increase for the last 6 months, and I know we've been talking about it. There's a couple things that are different this time around. Number one being the tone of the central bank. In previous releases, they really emphasized that they were going to be relentless to get inflation down to 2%, and they were going to continue to increase rates. They really shifted their tone this most recent release and sort of softened things by saying, well, we're going to step back and assess a little bit. So that's probably an indication that we've got to be getting close to the end of these increases. Another interesting thing is that prior to every increase since March, fixed rates went up, and this time we didn't see that. So the fixed rates are dictated by the bond yields, and the bond yields are sort of tipping us off that we might be close to the end here. To give an example of where we're at rate rise right now, if you wanted a variable rate, you're getting a discount of about 0.25%, 0.3 off of prime. So that puts you just over 6%, 6.1, I'd say, would be in the average. And for the first time in a long time, we now are actually seeing longer term fixed rates lower than that variable rate. So again, another indication that we're probably nearing the end of the increases. Right now, a 5-year fixed is about 5.29, and it's actually the shorter term fixed rates that are the highest. So a 1-year and 2-year are being pretty close to 6%.
Future outlook for 2023, Dara.
Yeah, you know what? We can't discount the fact that there could be a couple more increases. It would not shock me if they raised it another 0.25% in January. I think that's what a lot of economists are predicting. There could be a further increase of 0.25% after that. And then, the general consensus is that we stay flat from there. We could start to see some mild decreases towards the end of 2023. So that's the general consensus out there, is that we're nearing the peak here. We're going to level out there for a little bit and then start to see things creep down, not to pre-pandemic levels or even pandemic levels, anywhere near that, but some mild decreases, maybe back into the 5% range. If I were to make a bold prediction, I would say that when we reach that point where they start to cut it, they might unwind this faster than we think. And, there is some signs that are pointing towards potential recession and deflation. So if that were the case, there might be some drastic cuts. But if you follow the professionals that are paid a lot of money to study this, that's the general consensus, is towards the end of 2023, we'll start to return to maybe a high fives for prime.
Wow, that's an ugly prediction where that's the good news if we can get back to high fives. But I think a strong message, the data is the data, and the strong message is if you are thinking of making a movement, then probably getting pre-qualified just so you got that in your back pocket. Wouldn't you say, Dara?
Yes, absolutely. The bank qualifies people on a stress test, which is a bonus rate, and that as rates continue to climb, that keeps climbing. So it's a moving target, and what people can qualify for is a lot less than it was 8 months ago, and that continues to change on a regular basis. So absolutely, if I can give anyone some advice, it's get pre-qualified, know where you stand before you get out there and invest your time in looking around.
Sure. No, thank you so much. To go back to that stress test now, so you pretty much have to qualify in the range of 7.5 to 8 in order to buy something. And I think that's especially if somebody is an investor, that will squeeze a lot of people out. I think that there could be a really nice buying opportunity if people are willing to wait the long game. And that might be whether you're purchasing a home or whether you are purchasing a rental property here. How does this affect your mortgage? So here's a little bit of math for you. On a $500,000 mortgage amortized at 25 years, when the interest is at 5.5, you're looking at about 2,900. But if it went to 6.5, you're looking at 33.49 per month. So you're essentially, for every point on every 500, you're going up in the neighborhood of almost a little over $400 over here. So that's pretty heavy, especially if someone has $1 million mortgage, for example. It can really affect the bottom line. So one of the things is if you were right now in the process of getting a mortgage, here's a bit of a guideline that we are recommending. So if a short-term fixed rate mortgage, this would be the strategy if you think that the rates will go down in the next year or two, but you want to lock in a rate. If you're going to do a 5-year fixed, if you think inflation is going to be sticking around for a while and your finances are going to be tight, and you feel that you could actually afford that first initial hit, and you just want to sleep well at night, then pulling the trigger on the 5-year fixed. Now, a 5-year variable would probably be your strategy if you think and believe what the economists are saying, and that is that they will trend down eventually. We don't know. They're thinking end of 2023. If that prediction comes to fruition, then potentially a variable rate mortgage might be the better one to go right now. I know it's not easy. Nobody has a crystal ball, which is usually why we say work with a professional in order to help you to navigate this information. So I'd like to do my report on the Canadian housing bubble. And many of my clients wanted to ask, is it going to burst? And when we say burst, the last burst we saw was what happened to the US in 2008. They definitely had a housing bubble burst on them, where you had, Nevada, $700,000 houses worth $300,000. You had condos that were, $150,000 now worth $40,000. So there was an actual burst. So is the Canadian housing bubble going to burst? So why might it? Well, we grew too quickly, first of all. When the national average is 6% and we had markets that were going at 12, 18, 20%. And then all of a sudden you get these steep declines. Now we've just talked about, we've had a steep decline at 10% in the last 6 months. And that's very reminiscent of the quick declines we had in other decades like 2008. Then of course we have, the high interest panic news of the high interest rates. And we had unaffordable housing like pre high interest rates when they were in the 2s. Now that they're in the 5s, there's even crazier. So is this a similar condition to the US? So I'm going to talk about some economics over here. So yes, we went significantly quicker than other countries in our Canadian housing prices. And yes, mortgage rates are going down significantly quick. So these are two signs that maybe, you know, this might be the tipping point. And so both of these are reminiscent of what happened in the US in '08. Housing prices went up too quickly, too fast, and then the mortgage rates moved on them. And then you had people that were caught essentially with homes that they couldn't afford anymore on a cash flow perspective. And you also had houses that had less equity that was in the actual mortgage. But based off of multiple reports that I've read and information that I've gathered, will our housing bubble burst here in Canada? And the quick answer is likely not. Likely not. There are various factors that I want to go over. So the economy, immigration, education to income, and homeowners equity ratio. So in November 2020, in November of last month, there was a report by the Canadian press released by RE/MAX. 60% of Canadian housing will be in a balanced market in 2023. We're already seeing that. A market such as ours might shift to a seller's. But in certain areas, we will go down. So according to the Canadian Housing RE/MAX report, Ontario will go down, Vancouver, Lower Mainland, and some of the guys who went up really, really quickly, such as Kelowna and Nanaimo, they will go down further. But not all of Canada is going to go down. You know, Alberta is actually expected to go up, and New Brunswick is actually expected to go up. You got to remember, people have to live somewhere. Immigrants are still coming in. They still want to buy, but they might just be going to save for more affordable housing with their high interest rates as well as job prospects. So the importance of Canadian housing, it is really, really tied directly to our GDP. And here's a quick graph showing our comparison against the US. So 4.67% is the percentage of real estate reliance inside their GDP. Ours is 10.13%, so it's over double. What does it break down into? This is ownership transfer costs, renovations, new construction. So you could tell that it would be a very, very quick fix if we do head into recession for the Canadian government to kind of bring us out of recession just by stimulating the real estate market. How can you easily stimulate the real estate market? Lower the rates a little bit, right? The other big factor is our population growth. If you take a look graphically, the gray area, 80% of Canadian growth, population growth, comes from immigration. So unfortunately, it's not a natural immigration. We're not having like all of these so many children, but instead we have immigration coming in, and that of course is helping us with jobs, taxes, you know, productivity, GDP. But one of the things that we should understand is who are these immigrants coming in and why are they supporting our real estate housing market? So the first thing to look at is the high percentage compared to other countries, especially other developed countries, of the immigrants coming in with post-secondary education, right? So we have a little under 70% with post-secondary education that are immigrating to this country. Now, those who are immigrating to this country, we have almost 80% of them with their getting employed right away. So you have highly skilled people in Canada with a high employment rate coming in, significantly higher than, of course, other countries. Then how many of these immigrants are aiming for home ownership? It's one of the highest compared to, again, all of the other countries, all of the G7 countries. We have about 65% of them who are homeowners. And I know that there would be also a large majority of them that are struggling to try to get home ownership. So it's not like these the people immigrating to Canada don't want to buy homes or don't have the ability to buy homes or don't have the education to buy homes. They have all of those things. So the other one is thinking about in Canada, where does the majority of our assets, of our wealth lie? And if you see, we've got this large light blue area is the equity in real estate assets, you know, as compared to stocks and bonds and other assets. So we, as Canadians, we have an enormous amount of equity in the real estate that we currently own right now. So what does that mean for equity ownership? If you take a look at us compared to the US, we have enough equity in our homes that we could actually cushion, a downturn. What happened in '08 will likely not happen to Canada, in the sense that even if our home prices go down 20%, our equity value will still be higher than our mortgages for the average Canadian. And that, of course, will help us to ride through, the tough times, okay? So my conclusion here is, the economics do not support a Canadian real estate bubble bursting. If it does happen, so be it. But right now, the signs are not showing it. A correction is likely, which of course we're experiencing right now. So yes, but corrections are natural. Corrections are very, very natural. But should we be buying real estate right now? I think that comes down to affordability. If it's your own personal home with the stress test at 8%, yeah, if you could afford it at 8%, there's actually bargains out there, I feel, as compared. So if they were 10% higher last year, that means they have the potential to get back to that 10%, which I 100% believe that they will. If we go down another 5 or even another 10, that's even a greater discount. I think it's more about affordability, using things like rental suites, using things like, don't buy so much, and make sure you stay within a good cash flow position. That'll just help to keep you safe and sleep well at night. If you're an investor, we're going to talk about what the 3 analytics you should be looking at if you're about to buy. Okay. I'm not a big fan of trying to time the market. If I'm a real estate investor, I look for deals. If the deal makes sense, I buy it. I kind of ignore what the rates are, ignore what everybody else is doing. I'll take a 12% rate if the deal makes sense. If no one else is buying something, that's probably actually the best time to find a deal, because that seller will be a lot more motivated. Okay. So don't forget the 3 regrets for real estate investors. They are: number 1, I should have bought more when I had the opportunity. Number 2, I should have bought earlier. And number 3, I sold too early. So right now, I feel that we're in a very nice climate for real estate investors. If you're not sure what you're doing, you probably want to reach out. Many clients right now that are listening are clients. If you're not a client, but you want to hear a little bit more, then by all means, reach out. So, not trying to time the market. Predictions: lending rates are going to go up. We're going to lead to significantly more of a buyer's market. And what I'm doing right now, especially with my investment clients, is analyzing real estate comparisons across Canada. So Vancouver, even though we've come down by 10%, it's still expensive. Are there better cash flowing deals outside province? And the quick answer is yes. So I want to talk about the 3 fundamentals that we look at whenever we're talking about real estate investing, and that is the cap rate, the cash flow, and the internal rate of return, also known as the IRR. So the cap rate is a wonderful metric for us to compare one piece of real estate to another. This is net operating income divided by purchase price. So we want that percentage to be as high as possible. So if Vancouver, we're getting a cap rate of 2%, and let's say in Ontario, we're getting a cap rate of 7% or something of that sort, then it's just one metric where we could say, oh, it's got a significantly better cap rate due to operating income. Cash flow, of course, is simple. We take into account the amount of income coming in through rental, and then all the expenses going out, which include that high interest rate mortgage, the strata fee, vacancy, property management fees, everything. Of course, we'd like to see a cash flow or at least a break even. Now, for negative cash flow, does that mean not to buy it? And the quick answer is no. We need to now lean on the internal rate of return. And the internal rate of return is what is the amount that I can get for my deposit, which, maybe 20% down payment, as if I just put it in the stock market. In the stock market, let's say I can yield 8%. What's the internal rate of return on the real estate? It's a much, much harder number to calculate, because we are factoring in equity drawdown due to paying down the mortgage. We're talking about capital appreciation on the way up, and we're talking about cash flow due to rent. But here at Latitude West, that's one of the numbers that we do calculate. And then we now have investors that can make an informed decision to say, hey, that IRR is 12% or 17%. Stock market, on my best day, I'm hoping for 10%. So then maybe it is a decent investment, even if there is a little bit of negative cash flow. So this over here is a downtown condo, pre-construction, $750,000. So when we ran this number, to give you an example, we're projecting this at $2,800 per month. Vacancy rate at about 5%. We'll get a local property manager to manage it at about 8%. And we believe that this condo will appreciate at about 6% annual on average. And that's kind of the average we've determined here in the Lower Mainland. So when me and my team have analyzed this, we get a cap rate of about 2.9. We get an internal rate of return of about 10.74, but that's over 20 years, you know. But the cash flow is brutal, negative $1,500 a month. So unless we could generate more cash out of this thing, this guy is going to be bleeding money every single month. So when we run the numbers, our cash on cash return, if you were to sell it in year 7, you know, you would have lost money. You got a negative 7% return over here. But what we want to do is we want to try to understand, you know, when does this actually make sense? You know, when does the value of it make sense? If the value of the property itself is going to go up, which is why we have a positive return, but the cash on cash return, because of the amount that we are putting in each month, that's what we're getting killed on. So this is the type of data that we're able to do for clients in order to help them to make a purchasing decision if they are thinking of buying some real estate. So if we shift out of province over here, here's a sample of a property that we helped analyze. So this one is obviously out of province. I purposely removed the address. So this one is $450,000, but it was unique because it was close to student housing, close to a university. Because of that, it was able to be chopped up into 3 separate rental dwellings for students, generating $3,450 in rent. It did need some renovations, about $20,000 before the purchase property. But if you take a look at the numbers, the cash flow was fantastic. The cap rate 7.19 compared to the first example I gave at 2.9, and internal rate of return over 20 years be 21%. So this is where I mean that do deals exist? And the quick answer is yes. At all times there deals exist, but you know, are you able to find them? You know, maybe some of you are, other of you probably need help. This over here is a condo. Again, address is removed. This is an Airbnb for $350,000. It's out of province. It is in a downtown core though. I got 20% for property management fees because it's Airbnb. 20% down payment. And this is a short-term rental that will be usually we can get about a 70% occupancy rate. And what do we notice over here? Great cap rate, 7.2, good cash flow, 681. And we also have a wonderful IRR of about 19%. So I do think that there's going to be some great real estate opportunities coming in 2023. And I think people should gear up if they're in a position to actually buy anything. This last guy over here, we're looking at a very, very solid internal rate of return if this was to be added to the portfolio. And of course, we're not worried about the cash on a monthly basis because it is cash flowing. So I want to shift gears now to the stock market. And then I want to wrap it all together with my recommendations. So what is the stock market outlook for 2023? So I've been collecting data from multiple different sources. And the first thing to talk about is a recession coming? Is a recession coming? Because that won't be good news for the stock market. There was a report by Dana Peterson, chief economist. In her research, 98% of CEOs of large major US companies believe that a recession is coming in 2023. Now, why is this relevant? Why is this relevant? And the reason why this is relevant is because when people think that there is a recession coming, they tend to prepare for a recession. And when you prepare for a recession, oftentimes there ends up becoming a recession. So I want you to think of COVID when people thought that there was a problem with our supply chains, and there was not a problem with our supply chains, but people were rushing to Costco and, you know, hoarding items like toilet paper and different other items. And then it actually did cause a supply chain problem. So there wasn't a supply chain problem, but then people thought there would be one, and then they ended up causing one. So if 98% of CEOs believe that a recession is coming, what are they going to do? They're not going to be frivolously spending. They're going to be tightening their belts. They might even be laying off some people, and they might be holding on to cash. Why? Because they believe that there is a recession coming, and that itself might cause the recession. So Dana Peterson also felt that if there is a recession, it will be short and shallow, not a long, deep one. What's one thing that'll be driving it? These increased rates, slowing down housing will probably be the tipping point. So which way do we believe the stock market is going to go? In the same time last year in December, stock market was at about 4,700. Okay. Morgan Stanley's chief equity strategist was interviewed recently, and he believed that Q1 earnings seasons will be low. This will have a negative effect on the stock market, and the stock market will continue to go down. So right now, stock market is at around 3,700 as of the time of this recording. Like I said, it peaked at 4,700 this time last year. Morgan Stanley believes their bear case is going to be 3,600, base case 3,900, and their bull case is only 4,200. So when their bull case isn't even back to the December 2021 highs, it leads you to believe that no one is predicting like a V-shaped correction. No one is predicting that, the economy is going to do very, very well, very, very quickly. So both pieces of data support that I think we're still in for a bit of a rocky ride when it comes to the stock market. Now, if you have a long-term horizon, a long-term view on the stock market, then absolutely this is a good buying opportunity. Why? Because we know eventually it will go back to those highs, but you have to be, we don't know where the bottom is. You have to be ready for that volatility. If there is a slight bounce and a correction, they're believing summer 2023. Basically in the bounce will come from Q3, Q4. Now, like I said, all this information is for educational purposes only. All I'm doing is filtering and giving the information that I've collected. I'd be very, very careful by just taking this information and running with it if it doesn't fit your scenario, okay? So what are some other exciting things to talk about? The crypto crash due to the FTX insolvency. So this was a cryptocurrency exchange where there was a massive scandal. And they believe that there was at least 1 billion loss of client money. So then there was a big, sort of draw everywhere. People were a little bit hesitant to be inside the crypto space. So a lot of people started to realize this could be a riskier investment and an unsafe, unregulated investment. So Bitcoin right now is down 65% from its all-time high, 62% from the year to date. I definitely am not going to give any advice on cryptocurrency. I just wanted to repeat the information. If you do believe in cryptocurrency, if you do believe it as an asset value, then is this a good time to buy? Well, from those economics, the answer is yes. But if you believe that this thing is, it could potentially be worthless, then I would advise that you either stay away, or if you have a little bit of FOMO, if you're missing out, just a tiny, tiny, tiny little bit, which is what I've always recommended. So stock market volatility, I want to kind of talk about what we're doing here at Latitude West and how you might be able to get involved. We do not like volatility at all here, and we like to keep our clients' money safe, but we don't like to give up large returns either. So we're not going to stick all of our clients in GICs, because then we're going to miss too much on opportunity costs, as well as there will be inflation will be eroding us. So if you can't handle the volatility, and here's a good example of the volatility, everything from 2008 all the way to 2021, you see these incredible swings and into the positive as well as into the negative. Last month, in October, we were down 24, which was close to its bottom. And then we started to make some headway and start to climb back up. But if we take a look at what the wealthiest investors and largest institutions are doing, I'm going to use the Tiger 21. The average investor there has $100 million. and I'm going to use the Canadian Pension Plan. They buy hard assets of real estate. They do have stock exposure, but not stock reliance. Less than 50% is in the actual stock market. And then they have this wonderful form of fixed income and reserve. And that's the money that they could pounce when there's an opportunity. So they have money that's constantly growing, and they have money to pounce whenever there's an opportunity. So Canada Pension Plan has the same criteria. Canada Pension Plan has averaged about 12.48%, beating the S&P 500 by about 56% over the last 10 years, which is an outstanding number. So let's dissect both of these portfolios. You know, the Tiger 21, 26% in hard assets, real estate, 20% fixed income. They have a little over 50% in either a public or a private stock. Take a look, that's Tiger 21. Canada Pension Plan, 21% in real estate, and they've got this huge amount in fixed income as well. So Latitude West, we have something very similar. We encourage our clients to have real estate exposure, because then we're sleeping well at night when we don't have all that stock exposure. Stock exposure does play a location, but it's not a reliance. It's not a reliance, it's just an exposure. So, you know, if you have a standard 80-20 split on a stock bond portfolio, you're going to have 7% return. That's the average for the last 20 years, but you're going to have a ton of volatility at that 13%. Whereas our portfolios are different. We get, you know, our direct real estate, and I've given you some examples of the types of IRRs we like, you know, in the neighborhood of, you know, 17, 18, 22%. Then our core portfolio, we want nice, steady returns, let's say 8%. And our private funds are just absolutely kicking butt. And that is getting about somewhere between 9 to 12%. And our state bonds, which we find are significantly better than typical bonds too low yielding. Our state bonds are much better yielding, getting about 5%. So consistently, if we take a look at our asset allocations, they have consistently be just the benchmarks. So our core portfolio right now, stock market is down 17%. Our core portfolio is up 6.1%. And this is our conservative portfolio. What do we notice in the last 10 years? Never had a negative year. Never had a negative. We don't have the same volatility over here. And what do we notice about our private investments? Average 13%. And take a look at the last 12 years, never had a negative year. So we're up at 11%. So right now we do have a lot of clients who invest with us, but we do have a lot of clients who don't invest with us. And if you like what you're doing right now, stick with it. I'm not here to tell you to switch. But if you don't like what you're doing, you can't stand the volatility, I invite people to, you know, set up a time to talk, and then we could talk, you know, for people who are clients, maybe they're only clients on the insurance side and they haven't really utilized us on the investment side. So should you be using an advisor? You know, I think the quick answer is yes, especially if you need help on the real estate side as an investment, especially if your stock portfolio is not doing what you think it should be doing. Statistically, you are significantly better off in wealth, according to the data, if you use an advisor and utilize an advisor than if you do not. So now's that time. You know, if anyone has any questions, by all means, put it in the chat and I will help to moderate it. If you are listening to the recorded message, then we invite you to connect whoever it is you are trying to connect with. For myself, it would be an assistant at latitude-west.ca. For Dara at Citywide Mortgages, Dara at citywidemortgage.ca. For Ryan at rwrealestate.ca. So just a reminder of what we do here at Latitude West is that we are financial advisors, where we traditionally, of course, are licensed in both insurance and investments, but we also like to help our clients investing in real estate and understanding how they can diversify their portfolio either by buying real assets or by buying passive real estate assets. And we've been very, very pleased with our outcome for 2022, just because we have not been exposed to the same volatility and we are up on the year. If you want to take a discovery meeting to figure out to see if what we're doing is fit for what you are trying to do, then our discovery meetings don't cost anything. Please feel free to book a time with us, and we'd be happy to go through your situation. So if there's any questions, throw it in. But Ryan, I'm going to start off a question with you,
Sure.
if you are still there.
I'm here, yeah.
Okay, so I'm wondering if you believe that buying in 2023 personal home is a good idea, if but not selling. So it's essentially going backwards, where there is a deal out there, but I might not get the greatest price for my own home, so I will rent my home out. I will buy a discounted home. Let's assume that we have enough equity in our home and we're able to do this. If you had the means to do it, would you say that is a good idea?
So you're talking about for buying for investment or principal residence?
Principal residence.
Principal. I do think so. And we say to clients, as long as you're looking at the long term, which you kind of touched on. So we've always said in the last 15 years that I've done this, that look at a 5-year period. So I think if you're buying now for the long term, it is a good time, because you're getting relatively good discounts. So even though the rates are higher, you're able to get a home at a pretty good value. So as long as you're holding it for long term, I think it is a good time, because you don't have that competition. You're getting a pretty reasonable price, and there is some motivated sellers out there depending on their situations.
Yeah, and Ryan, you've been in the business for a while. I could see all the gray hairs, but
Yeah,
they
yeah.
probably came in the last week.
Right. Yeah.
And you and I have been together for a while, and we've done this workshop many times. And 90% whenever we've given a workshop, it's usually because the market's crazy. It's a frenzy. It's people are overbuying, and I've always been fascinated when people believe that when times are good, they think they're going to be good forever. So I've often said, there's the craziness and there's the frenzy. Do you sure you need to buy right now? He says, of course, because it's going to last forever. And then when you have these incredible slowdowns like we're having right now, you said that you didn't get one inquiry on a house or a place you just listed, but it's the same people living in the same city.
Right.
And it's kind of seems weird to me. It's not like a fresh batch of people or a fresh batch of real estate. It's the same real estate. And can't people kind of see that at some point, why would you want to be part of the frenzy? Why wouldn't you want to be buying things when things are calmer, if you want to buy, if you're in that position to buy? And so, like, what are you telling clients right now who are trying to stay on the sidelines? Are you saying keep waiting, or are you saying now is a good time?
Well, we're trying to tell them that now is a good time, and very similar to COVID. So when COVID started, the people that bought at the beginning of COVID are still up quite a bit, because that's where you had some pretty heavy discounts, because that's when all the fear struck in and nobody wanted to do anything. Nobody knew what was going to happen. So it kind of seems that unfortunately most people follow the media, and they get kind of worried about what is going on. I mean, granted, inflation and everything has gone up, but usually this is the time that you would want to act, when you don't have that competition, you don't have everybody running to a property. So we do say to people, take advantage of it now. You have less competition. Real estate always goes back up in Vancouver. When the rates come back down, the prices will go back up. So, but it's hard, depending on people's situation, it's hard because there's so much negative stuff in the media. So I think you kind of just have to look at real estate for the long term and, understand it would do well. And then you kind of touched on it too, like the immigration aspect. There's so many people moving here in the next 3 years, and we still really haven't solved the inventory crisis. So if you look at the inventory, there's still not enough homes for what people need, especially in Vancouver proper, which is why they're increasing density to triplexes, for example, all the way up to 6 units under the Vancouver plan. So you can see there's not enough options. So if you're able to buy a home right now, I think for long term, you're in a good position.
Yeah, my last question here is about pre-construction, because there's not a lot of wiggle room on pre-construction. It's not like a house because it's a builder selling it. It's not an individual. Are these guys, like discounting anything, or it's like, no, that's the price. You got to take it or leave it, or most of these guys sold out. Like a pre-construction that was like being released right now, I couldn't imagine a worse time. Like, what are they doing?
They're starting to discount, and yeah, like so for pre-sales, I'm never a huge fan, and unless you know that you're getting in sort of at the beginning of a project, so you're the first person in and you're getting the best possible price. I mean, for example, I bought a pre-sale at the city of Lougheed almost 7 years ago. I mean, it's gone up in value, but they're often delayed. There's all kinds of stuff happening. But the pre-sale where I think there is going to be some deals is people that have bought, unfortunately, last year or maybe even the tail end of the summer. Some of these people won't be able to complete because they were kind of basing it on their incomes or the rate staying a certain range. So I think actually for the pre-sale market, there'll be some deals with people that can't complete, unfortunately. So people that have to sign their contract as they get closer to completion, they're not able to close on that product. And then those people will look to try to get their deposit back. So they'll probably discount their pre-sale pretty significant in some situations.
So they're able to sell to discount and assign they'll be able to assign it for less than what they paid for that, less than what they agreed to it.
Yeah, I think in some cases they're going to have to, unfortunately. So a lot of these ones where you put down, let's say, 20% deposit, 80 to 100,000, and you can't afford to close on the pre-sale, or in some cases the pre-sale has actually gone down in value. That buyer is just going to want to recover some of their deposit costs. So they're going to say, okay, well, if I can get something back, even 30, 40 grand, I will sell you the pre-sale at a discounted price. And that's what we've seen in previous cycles, unfortunately. So pre-sales, you have to be really careful that if you're buying something right now, that one, you're getting a pretty decent price and that you're looking at the long term. But because of pre-sales, the prices change all over the place. You could buy the same unit in the building as somebody else and have paid quite a bit more or less depending on when you bought. So you really have to be careful. But I do see that happening, unfortunately, because pre-sales, they also don't pre-qualify you. I could walk into any sales center this weekend if I have 80 grand deposit, and they're not going to question if I can get financing in 2 to 4 years. So that's an issue because they haven't pre-qualified the buyers, and then it comes up to the interest rates have gone up, so these buyers can't afford to close on the property, or their job situation has changed, or they're on maternity leave. They won't be able to close on it. So I think there's going to be some deals there for people that are looking for investment side. There's going to be some deals on the pre-sale side from the assignment standpoint.
Got it. Well, Ryan, thank you so much. I think this information is valuable. I hope everybody got some wonderful value out of this. And like I said, this was given for educational purposes, but if anyone would like to connect to talk about anything that we've discussed, we invite you to do so. So that is our year end for 2022. And then we will be doing probably another report somewhere in Q1 of 2023. So Ryan, Dara, thank you guys both.
Thank you.
And we will see you guys in the new year.